Founder need to be optimistic by default. If you have a pessimistic founder, you don't have a company. Things that you want to measure is basically growth, unit economics, company ROI, customer repeatability, and cash and runway. How you are doing this, there are just different metrics.
Xavier Castellana has been the CFO of Typeform, valued at almost $1 billion, the CFO of Travelperk, valued at $2.7 billion, and now the CFO of the scale-up Amenitiz.
What do you think are the common traits that sets companies apart from others? Really the one that explode and grow exponentially?
I'm usually looking at three things. First one is market opportunity. How big is the opportunity here in terms of number of customers, how much you could sell to these customers. Second one is that the product is solving a real pain. And for me, the last one and the most important is
Xavier raised more than $350 million of funds in equity investments and financing for his startups, and he managed 3 exits in his career.
Fortunately, I've been in this situation when we need to make massive layoff. It's not an easy one. I will say the biggest challenge there was what concerns me the most is what is the price that we will pay as a society for this level of technification.
Hi Xavi, very glad to have you here today.
Hi Diego, thanks for having me for this podcast.
We've been knowing each other for a few years now. Sometimes, we collaborate to help startup scaling, and I'm always impressed, about, your insights and the experience that you bring to the table. So I'm really happy to have you here today so we can share everything to a larger audience. And I would like to start first, from the top, from your motivation in general as a leader. So if you can share with us what drives you as a leader and keeps you motivated.
That's a great question. My motivation, I think that has been changing as I'm getting older. I'm 50 already, so it's something that has been growing through time. I think my main motivation is to basically I have three main motivations. So the first one is helping business to scale. So I love the part of the creativity that you need to put there, the rush, the uncertainty and the challenges that you have when you need just to scale business. It's in a fast growing pace. It's always a big challenge, and this is something that even at some times it could be painful. It's something that I really love and drives me. The second part, and probably this is one of the ones that have been just changing a little bit more across my career, as I gain a little bit more insight and more experience, it's how to help founders and the leadership team to ask the right questions. So I think that there's a lot of unknowns when you are scaling. That what are the next step, what are the main risks that you could foresee, what are the things that you should take into account. And for me, it's something that I think I still have kind of a pedagogical part of me that tries just to help LTs just to bring their best and to help them asking ourselves the right questions and just bringing the big topics to the table. And connecting to this, actually, this is one of the things that I learned through this process. If you want to be successful in a fast-growing startup, I think it's actually in any single company. You need to have a leadership team, not a team of leaders. So usually when you want to be successful, it's not about, hey, I'm representing finance or data in the leadership team and somebody else representing sales. It's when we are as a leadership team, we are talking about the company, what is best for the company, what it will help the company to grow. And then, of course, everyone could bring their just area of expertise and insights in terms of course, I will speak more about finance than marketing or than sales because I'm not the subject matter expert there. But I think it's important that when you are thinking about the strategy, how you will land this strategy into the tactics, how you're going to communicate these tactics to the full company, and this is a leadership team work. So it's not of a functional one. And I think that the last one for me is just helping the teams that I'm managing to be more strategical and more business focused. Data, finance, legal, something that usually you could assume that it's a kind of a commodity. You could have a finance team that it could be working for a grocery or for a fast scaling startup. It's not the same. You need to be really connected to the business. You need to understand the business, and you need to understand what are the levers and drivers and risk of each business in order just to do your work properly. So I'm just trying always just to help them understand what is happening in the business and how they could help the business. These are my main motivations, basically.
So definitely, we will dig as well on this area from the strategic perspective, because of course, in your role, the strategic part is so much important, the business and strategic part, which is also what has helped you as well to raise so many investments. So if you can maybe share, in terms of numbers, first, how much you have been raising and for which companies so far.
Yeah, well, I mean, I've been just working for 5 different startup scale-ups across my career. I never just make the math, but I will say that between equity and debt, I raised something around 350 to 400 million in this threshold, approximately. Different stages, usually between Series B, Series C, or special situations. So usually you don't bring a CFO until you have a Series A, and you could start you have money to manage usually. So before that, it's more of a kind of a founder thing, which I think that actually it brings challenges. The role of the CFO, or somebody who is looking at the overall health of the business, it's something that it's relevant at any single stage of the company, for sure.
Yeah. And looking at all these rounds like that you've been doing, what do you think has been the most difficult one from your side, the most challenging one, and why?
Good. Well, there's one point, and actually I will correct myself. So I say that I raised. A CFO didn't raise. So CFO is saying that I raised this amount of money. It's a false statement. Actually, you help to raise, and you could help in different manners. But it's a company effort. It's not even the founders that raise. So it's a company effort. So you need a company that is bringing the right trajectory, that is showing the right trends, that is showing the right metrics. These are the situations where things are easier. So when everything looks green, it's usually easier. The toughest times are usually when, and I've been in different examples, when not all the main KPIs or the most important ones are in green, and actually what you are trying to raise is just to bring these red KPIs into green. This is where it's more challenging, because at the end, especially when you are going Series B, Series C, that it's less about the project, is more about showing data that you already has accomplished some of this stuff, and how you are going to speed up the process of just making this multiplying more and more. This is usually the most challenging ones. Additionally, then there is market. And market, you never know. There are situations where since that the market it's perfect, and then it gets challenging for whatever geopolitical or whatever situation. We had the COVID, we had the war in Ukraine. Now we are just having the Liberation Day that has happened this week. So there's a lot of things that could change dramatically from one day to another. What are but I would say if you are in a with a good metrics, it's always easier.
Yeah. And if we look at the different stages, because of course you've been there when Typeform, closed, I think it was around 135 million in Series C, but also you've been closing much smaller rounds, from Series A, B, and C. So what would you think are the main differences, when it comes to cross like a deal of over 100 million to one of maybe 10, let's say?
So there are some commonalities and some differences. So I would say that the commonalities, I would say what is important in terms of what you need to take into account. It's the purpose of raising. And usually the purpose of raising is what is changing from Series A, Series B, Series C. Series A, usually you should have kind of an MVP, and what you are raising is actually just to invest in just finalizing your MVP, making that like a product that is available for the big audience. You start to have like a more structured kind of a company, and you are having your first leadership team hires. When you are going into Series B, usually you have a little bit of good test that there is a go-to-market, there is a go-to-market motion that is working, and it's more the part of the scale-up. And Series C usually is how you start to go on the path of taking over the world. So whether it's just differentiation of different portfolio products or just different markets, it's about the repeatability of what you already have done in your just scaling up about to market in Series B into the broader audience, whatever it's, again, just new markets, new products, new packaging, new ways of doing business.
Okay. And if we look at, at the main mistakes that that the CEO or CFO, should avoid in these phases when raising funds, what do you think are the biggest one, or even the hidden ones, that maybe you face or you have to overcome?
I think one of the first ones is the time to raise, and it's a challenging one. It's a really challenging one because, of course, you want to raise especially if your business has seasonality that most of the business has, one way or another. You always want to raise when you are just showing that the growth is going like in the. For this, you need to. There will be an amazing information that you would love to have. That is how long it's going to take you to raise. Which usually it's a difficult one because it's something that could happen between couple of months, 6 months, 9 months. It depends on the situation, it depends on the part of the company and the interest in the industry. So this is one. The other one that is it's difficult to avoid too is when you are talking about valuation. Most of the companies that have been, so it's really difficult to assess what is the right valuation of a company, because it depends a lot on the metrics, on the interest, on the market, on what are the multipliers out there, what are the multipliers that you are seeing, and the trends in the public market. But there is a usual trap that is, of course, the highest the valuation, the lowest is the dilution, the highest the amount of money that you could get. This is great, but this is putting a lot of pressure on the founders and leadership team for the following rounds in order just to keep that valuation and just keep on increasing it. And this path is getting harder and harder. So high valuations on Series A or on Series B are not easy just to maintain unless you have a business that is not just having any single bump in the road. And so far, I didn't see any business that didn't have bumps in the road. Every single business is just struggling from one thing to another. And if you think about it, it's normal. So by definition, if companies like big corporations that are growing less than 10% or 15% year over year are struggling with this kind of the day-to-day, imagine what happens when you need just to multiply by 1.5, 1.7, 2.2x, 3x at the beginning, etc. Of course, the revenues are pretty smaller, but just when you need just to do this, by definition, when you solve one thing, by definition, you are breaking another one that you need to figure out. And when you are just amend this one or just you put this one into shape, then the first one is not working anymore. And it's the permanent situation that you are living in a fast growing.
And looking at the situation, you were talking before about metrics as well, and those green metrics as well that allow to raise faster and easier. Could you give us maybe the general rules? Of course, it's going to change, from series to series, but what do you think are the main, most important metrics? And if you could potentially quantify as well those.
Sure. I would say that for me, it's my perspective. You could ask 10 different CFOs and will give you 10 different answers. Hopefully not that different. But so for me, the 5 main metrics that you need to track, it's growth. I would say more than metrics, I would say things that you want to measure. It's basically growth, unit economics, company ROI, customer repeatability, and cash and runway. How you are doing this, there are just different metrics, and when we are talking about metrics, then is when it changes stage by stage. When you are just thinking about growth, and you will use CAGR You could use AR multiplier if you are in the SaaS industry. It's the one that I just got more expertise in my recent experiences. Usually, when you have a company that is from 1.5x to 2x, it's good. When you have more than 2x, it's amazing. Less than 1.5x, it could be a little bit more challenging. Similar when you are talking about unit economics. Unit economics at the end is how much you are getting or how much is costing you to close a single deal, and how much you are making out of it. You could use payback, you could use LTV to CAC, that's just different metrics that you could use there. When you're talking about LTV CAC, for example, something between 0 to 3, the area you should be avoiding 3 to 6 or 3 to 5, it will be like good proxy. More than 6, more than 5 or 9x LTV CAC, it's amazing companies.
Sorry, just to clarify, LTV is lifetime value.
Sorry, exactly.
CAC is cost.
It's customer acquisition cost. Sorry, sometimes I get too much into my. Yes, at the end LTV, it's the lifetime value of the customer. So basically, how much you are expecting that a customer will bring you in terms of revenue in the life cycle that he has with the company. And acquisition cost is basically all the costs that you have in terms of go-to-market, but divided by the number of new customers that you are acquiring every period, basically. So then when we are talking about company ROI, this is something that it's evolving as the company grows, but usually you could start with more of the efficiency metric, which is how much you are just growing in how much new ARR you are generating, just divided by the cost of the cash that you are investing in that specific period. And this should be the closer to 1 as possible. So if you have something between 1 and 1.5, especially when you are more in Series B to Series C, it's good. The closer to 1, the better. If you are between 1 and 2, it's still good. More than 2, it's when it gets a little bit challenging. Okay? And then as you are growing, you could move more into the rule of 40, which is a similar one, that it's just basically calculating how much you are growing year over year in a specific period versus how much you are investing in terms of money in negative EBITDA or in terms of cash to generate this growth. So really it's just giving you the effort that as a company in terms of money you are doing in order just to keep a specific pace of growth. And then the last one, that is the cash runway, that this is the easiest one. It could be like the stamina that you have in your, that is to keep just doing things at the pace that you are doing. It's basically with the cash that you have in the bank, with the plan that you have when you are running out of money or when you are becoming cash flow positive. It means that you are just making cash out of your operations rather than losing cash.
And regarding this cash runway, usually what do you aim for, in terms of months of cash?
Usually, when you are closing a round, you are just looking at a time frame of 18 months to 24 months. What I always try to bring to the table when we are doing financial plans is that this investment should bring us to be break even in terms of revenue. So it means that the EBITDA gets positive, because then when you arrive at the point in time, you have a choice. That is, okay, I keep just growing slowly, but I'm just being profitable, or we decide that we just raise a new round and we speed up again the growth and we just get negative in terms of EBITDA. So this is the part that I found more interesting. So by definition, even I've been in the startup environment for a while, and it's a challenging way to keep this balance between growth and profitability. One of my biggest mottos is that a business should be created to make money, not to keep on investing and depending on rounds. So that's the final aim of any single business, is just to make money by itself.
Yeah, and regarding this, in terms of debts as well that the companies raise to finance this profitability or the growth itself. When do you decide that it makes sense more to raise equity, investment through equity, or through debt?
That's a very good question. Basically, because there is a say that usually financial institutions give you money when you don't need it. That's for personal life, and when you need it, it's a little bit more challenging. So when you are looking at a strategy of equity, that at that point in time, assess how much you want to do in equity, how much you want to do in debt. Basically, it's a matter of cost. When you are having equity, you have a cost of dilution. It's a big cost if the company is growing and to have a big valuation versus a cost of financial interest, basically. There is a second part that I think is useful, that is usually I will use fundraising and equity for raising investment in just making the company to finance EBITDA negative in order just to invest and just put the levers to grow. Well, everything that is more working capital in the situation, in the business, that is creating needs of working capital or specific investment in something really, really specific, is where I will probably go with more of debt.
Would you have like a range of maybe an ideal balance between the two, or it really depends from each company too much?
It depends from each company. I will say and it depends a lot on the needs. This is one of the things that probably it's one of the biggest learnings for me in terms of not mistakes, but things that you should just keep a good eye. There is the business trend, these revenues and investment in scaling up and scaling down, because you will have a little bit of everything in the full life of every single company, with what is the cash impact of just scaling and downscaling. And this is important. I've been in different business that had right opposite behaviors in terms of cash flow. So there have been in companies where the more we were growing, the more cash do we need in terms of financing this growth, because the working capital was negative. So it means that the company is doing well, but you need to finance your working capital for your customers for a specific period of time. It means that the cash needs are bigger. This means that in a situation of decreasing or stabilization or just flattering, your cash needs are lower. Where I've been in businesses that is the other way around, because the cash flows with the business, when you were scaling, you were generating way more cash than the one that you are just receiving from financing. But in the downscaling, this cash is challenging you because you are receiving money from your sales, but you are paying your providers from the sales of 2, 3, 4 months ago. That this in a situation of downscaling, it's tough, because then it's when you need to finance your suppliers. So this is one of the things that I think it's important that any single CFO, when it looks at the business, not only looking at the trends at the profit and loss to see how much is the investment, but look at the balance sheet and see what are the trends and make a good analysis of how this look like when you are scaling, how this will look like when you are flattening, how this will look like when you are downscaling. Because this could be a difficult moment, and the more that you could anticipate this, the easier will be your life.
And if we look, at the several companies that you have been in, because it looks like you have a good eye for, picking winners in a way. So companies that are really growing a lot. Typeform, almost a unicorn. Travelperk, now it's about, I think, 2.5 billions. So tell us, from your side, what do you think are the common traits that sets, companies apart from others? Really the one that are really explode and grow exponentially to others that don't do that?
That's a great question. I would love to say that I have a method, or that I have a very good eye for catching the winners. I'm not sure I have it. I would love the way that I have it. I think that I've been lucky on one side. On the other side, I'm usually looking at three things when I'm going to a new project. First one is a market opportunity. How big is the opportunity here in terms of number of customers? How much you could sell to these customers? How big is the TAM of this specific product and the collateral products that you will have around? That is the first one. There's a second one that for me it's really important. It's that the product is solving a real pain. And I think that sometimes I've seen companies that has built on top of a pain that is not there or that is not that relevant. And for me, the last one and the most important is just to assess the founder team and the leadership team. Because at the end, it's the one that is going to make the company successful or not. And the dynamics there, how decisions are taken, what are it's really difficult just to identify because all of this is changing, so that time you could unleash way of new opportunities. The product will be evolving and the leadership team will be changing because at the end that the companies are scaling, they need different profiles. But at least they'll give you a grasp of, hey, with these people, it seems that they have the right mindset. And when you are talking about leadership teams, I think that the level of ambition, the level of humbleness, it's important that you have this combination of, okay, I have like really bold ambitions, but I'm humble enough to know that I don't know everything. And there's things that I will need to learn and I will need to figure out during that. But usually when you speak with people, you could feel which ones of them has this curiosity and this willingness to learn versus who is more in the situation that, hey, I know how the industry works and I have nothing to learn. And the older I'm getting, the more I'm realizing that I have a lot of things to learn already. So this is something that I'm looking in the leadership teams that I would like to work with.
Especially because that relation as well between a CFO and CEO is essential. Sometimes you have the CEO is more like optimistic, while you as CFO you need to bring it back to reality. So tell us about this relation, as well. How should be ideally?
Whoa, that's a great one, and I think that yes, but by definition, when you think about founders, a founder needs to be optimistic by default. If you have a pessimistic founder, you don't have a company. The rule of the CFO it's just to bring things a little bit down. Sometimes it's easier, sometimes it's harder. But I don't think that it's only that this balance between the CEO and the CFO it's a two people game. It's actually something that involves the full leadership team. It's something that as a leadership team you need to have the different voices because at the end even the CEO and the CFO, we could just make a ton of plans. We will know a lot what are the things that are coming, and we need to know a little bit of all the different areas. But you have subject matter experts in all the areas that are the ones that are going to tell you, yes, makes sense. This is going just to go as expected, or hey, the level of risk that I'm seeing here is higher, or this product we could develop it in this amount of time, or no, this is going to take more. And this is and everything is correlated. So it's a business by definition. It's an interconnection of all these areas. These are the kind of things that I've seen in different companies. Usually, when you have this product, and even you could talk motions, product-led growth versus sales-led growth, marketing-led growth, etc. At the end, there is no single point of go-to-market. There is not a single motion that is working. It needs to be fully connected, and it needs to speak the same voice, and it needs just to be really aligned in what we are solving for our customers. What is our value proposition? What makes us different from the competitors? And why customers choose our solution versus another? And how do we create the moats versus a competitor?
Yeah. Yeah, indeed, the CFO as well becomes a business leader in a certain way in this environment. And being witnesses as well, company startups in which maybe they hired maybe well-known, maybe CFOs or maybe from a multinational background, but they didn't deliver, what they were hoping for, maybe because of that lack of experience in a completely different environment. So could you maybe give us, what do you think are the best traits, for an ideal CFO to bring in on board in a scale up?
That's a difficult one. What I would say is it's a little bit what I was saying at the beginning. That's my way of interpreting. And again, I don't think that there is an ideal CFO profile. Each company need to find the person that better balance this relationship within the business. But the way that I think, or the traits that I think that are more more important. For me, it's just to be super close to the business and really understand what are the levels of the business, but it's just the things that are making customer repeatability more successful and is helping to attract customers, that you have a good understanding of what the product is doing, because this is going to help you to have a good grasp of if the projections that you are putting are reasonable or not. I think that there's a need to have somebody who thinks strategically, not only in what is happening today, but what is going to happen in a year from now, 2-3 years from now. That could abstract, and this is something difficult when you are on the day to day. It's something that it could be challenging. As somebody who's always thinking, okay, the world doesn't end in the next month or in the next quarter or at the end of this year. So there's more things that need to happen, and that has a good heart health, because it's going just to be tested recurrently as a CFO. Because you are as a CFO, you are orchestrating a little bit what is happening in the company. So every single thing that is happening, that is going well, that is going just not as expected, etc., it has an impact in the full business plan that you have, and at the end you are the one who needs to say, okay, when this is showing this trend, it could just derive into this situation and just be specific, especially vocal. And when we are talking about business plans, and there is something that I learned through my experience too, that the business plan is not something that finance is doing, and that is the finance thing, and that you present to the board, and then you are just tracking. This should be a reflection of the company strategy. So it will be the company's business plan. And this is what you need to make sure that people align with what you are including there, and people is committed, and then things will happen. But it's not the CFO plan, it's the plan of the full company.
The business plan. And if you look at previous companies, for example, in Travelperk, you were there at the early stage of the company when we're really going hyper growth. And of course, there has probably been many high and downs in the situations, a lot of difficulties. What would you see the biggest difficulty that you witnessed there in that initial phase of scaling up?
I've been in the initial phase of some companies versus other ones that are more, and each one is a little bit different, but usually the kind if I could regroup them, I would say one usually in early stage is the lack of information, lack of data, and lack of metrics, and lack of reporting, that you have really few financial and business information, business metrics. Usually in early stage, it's what is more common. This is usually one of the biggest challenges at the beginning. Second one, for me, it's you could have companies that has been really strong in one side of the business and just abandoned the others. So just feeling companies that has been really focused on product, and the go-to-market, for whatever reason, it's something that has not been just top of mind, or companies that has been the other way around, that has been just putting a lot of pressure on the go-to-market, while in the part of products, I think something more. When I'm saying that hasn't been the focus, I'm not sure. So of course you could not have any single company that doesn't have go-to-market and doesn't have product. But the focus of the founders, it could be on one side and the other, And this is something that you see a lot when you see the profiles of the founders. That is people who is more product-oriented, people who is more go-to-market oriented. And how do you balance this, and how do you bring looking at the company as a whole and understanding a lot of the customer journey? And how do you help that the customer journey not only starts when the customer is hitting the product, it's not starting only when you have a lead and it becomes a customer. So it's a full line that you need just to make sure that you are just making the customer successful at the different stages.
Yeah, definitely many components there. And if we look maybe at the later stage, for example, in Typeform, so when you were more on a Series B, Series C situation there, what were the main roadblocks that you witnessed at that stage of company growth?
Yeah, when you are in this stage after 20 million, etc., and you need just to grow to certain levels, like the 80s, 100s, the discussion gets different. It's less about what has been the focus. You need all the things that I was just telling before in terms of product, in terms of go-to-market. You need to have something really solid that is repeatable, and then that you will make it just work several times. What you get there, it's the biggest discussion in terms of what are the different motions that you will bring you from one side to from your current level to the next stage. That is going just to help you multiply per 2 or per 1.8 every single year. It's probably not the same thing that just bring you from 0 to 10, 50 or 20 million. You need just to find different levels. And even when you get to the next level, that could be on the 50s, on the 80s, on the 60s, you need to find what is the next thing that is going to bring you to the 120s, 150s, etc. And this could be markets, could be product, so new product developments, could be different solutions, could be upsells. And this is where there's a full different discussion that is, and it's something that is challenging because you have something that just brought you to specific level. So by definition, humans we tend to assume that if we do the same thing, it's going just to bring us to the next level. It's that what we do as leaders. Every single leader that has been C-level in the past. It has a success story behind just doing things in a specific way. But this is not going to, you have no certainty that this is what's going to bring you to the next stage. You need to find different things. Same happens with the companies. So what you bring you to a certain level, it probably will leave you at this level or you will plateau at some point. So you need to find different ways, different motions, different markets, different products. That is what is going to bring you to the next level. The challenging part is that you will always try to, by definition, humans, we always try to bring things to what has made us successful in the past. Whatever is a product, whatever is a motion, whatever is a way of selling. So this is the challenging part. So how much you could just start to embrace something new and test something new and give it time enough to flourish and to bloom, while you need just to keep your current investment or your current way of doing things, and don't try to always link to the what just makes you successful. I don't know if it's easy to understand, but
of course, always making sure that that you need to always validate your assumption even when you are a later growth, because of course the future is not for granted. Can change at any time. Let's speak about the profitability versus growth relation here. Because of course you've been companies where you were raising millions, investing millions in growth. When are you looking for that profitability? When do you think is it's the right time to look for profitability rather than relying on those rounds over and over?
It's a great question, and actually, so by definition, when you are just in venture capital funded companies, growth has been, is, and will be by far the main driver. So it's really difficult that in a busy decade still raise the interest of the industry and on the funds there that is not growing. What it has been seen, and actually this is something that has happened in public markets. I remember just speaking with bankers like a year or a couple of years ago, who were sharing me the impact that had in the market capitalization, the growth, and this profitability. When we understand profitability, it doesn't need to be that you are actually just making money already, but that you are in this rule of 40, rule of 50 when you are in the public markets. That you have like that the amount of money that you are just investing in terms of negative EBITDA versus how you are growing. And it was interesting to see that if you are looking at market capitalization and you are looking at growth, the biggest market capitalization back in time was for the companies that was growing more, of course. But in terms of profitability, it was quite flat. So it was not direct correlation in terms of market capitalization versus how much the companies were more or less profitable or more or less in this rule of 40, rule of 50. And not, when they say nowadays was 1 year or two ago, you see that growth still was just one of the main drivers of market capitalization, but profitability was actually starting to show an important trend. So The companies that are just making business in a more profitable way or a more efficient way are just getting better value by the market, which is the same it's buying at the end when you are just going at VCs, because at the end, the aim of the VC is at the end it's just going public or just trying to go for an exit. It's going to be at multipliers usually similar to what you could find in the public market. So, as I mentioned, I think that you need to be as efficient as possible and try to be between the terms of what is good, great, in terms of whether it's burn efficiency or rule of 40 or rule of 50. So it's something that it's more and more valued in the last, or has been more and more valued in the last 2-3 years. And with the geopolitical situation today, I think that this is going to stay with us for a while. I don't think that we're going to get back to growing at any cost. It's something that will be back. And actually, in this sense, I think that AI is showing today a lot of opportunities in terms of have better efficiency on managing business and growing business. Still, we are in the early days, but we are seeing a lot of tools that is helping to do more with the same people that you have and to do it better. I think that still we are just at the surface of what we could do with AI, but it seems that there is one of the... We are going to have more demand of just being in efficient terms of profitability versus we have a good lever that I think that could help until we see that. Okay. What are the real costs behind AI?
Regarding this, what's your take, in terms of investment on this technology? How a company should invest in terms of, allocation of their investment specifically on this or experimentations?
On AI, I think there's a bunch of possibilities and it will depend on every single company, but areas like customer facing, like today, I think video still is a little bit, video and voice is still a little bit clunky, but text is really good in terms of communication with the customers, emails, etc. So everything that is customer facing in writing, it's quite evolved, and there's a bunch of companies that are doing good steps there. I think in terms of coding and review and making sure that the code that you are doing, it's better, it's more reliable, has less bugs, it's something that is good. And everything that is in terms of big transformations, just making transformations and getting information out of big amount of data is something that it's for go-to-market, content creation, for analysis, for finance, data. I think there's a lot of interesting opportunities there.
Okay. And if we talk more on different perspective from a crisis situation, I know that you've been in companies in terms of restructuring them in the past. So I would like to get your perspective regarding these maybe painful financial decisions that you had to take in the past. Could be layoffs, budget cuts, or restructuring in general. Can you share any of these?
Sure. Yeah. Unfortunately, I've been in these situations when we need to make like massive layoff. It's not an easy one. I will say the biggest challenge there was how to recover the culture of a growing company, so that when you have a massive layoff and then just to the day plus one that all the process is done, you need just to get the people that is still in the company and say, hey, and now we need just to go to the next stage and just recover the spirit of the company and just make the bet. I think that we underestimate how long was going to take the recovery of the culture of trust and engagement with the company. In the rest, I would say, I remember we have been just doing in all the different companies some investments and some bets. When you are doing bets, I would recommend that you start setting what is the definition of success of this bet. Otherwise, you could be in a situation where this is more or less working, not as expecting, but it's still working. So let's keep it until now. So you need just to put what is the definition of success and then assess at that point in time, hey, are we reaching the objective? Yes, no. What are the reasons behind? We want just to give it more of a second chance, but how long we want to give this second chance? Otherwise, it could be something that lasts for too long. The other one is how many bets do you want to do? And it's not only financial, it's actually as a company, it's when you are just preparing your business plans or your plans for the future, it's how many different things you want to try and what is the likelihood of success of this. Because of course you are planning for all of this going well and some of them not going well, but you could make a scenario of if none of them are going well, what is the impact? And I think it's important. And as I mentioned before, just to really understand what will be the cash impact in terms of working capital of things going as expected, how much money you will need in terms of financing if your working capital it's negative, or how much you will be on a trap if this is not working. If you have a working capital that is positive, that is generating cash, but in a decreasing situation, you need to pay your suppliers. So when you are at this level of business, but you're receiving the money of your customers at this level of business. So I think that these are the three main takeaways that I would recommend to any CFO.
Okay. And great. So last two questions here. If you can share, your final pieces of advice for a CEO that want to raise funds, what would it be?
Good one. I would say try to find the right timing. It's going to be longer than expected and heavier than expected. So it's something that it's important. Try to find in the timing when you are just getting in the right direction. Have a super clear idea of what you are raising for. So what is behind. And don't underestimate that when you are just doing fundraising, you are not putting focus on the business. And this probably is going to have an impact because you are not going to see the lack of focus from the CEO, from the CFO, from a lot of members of the leadership team that will be involved in this. It will be a focus on the business, and the business will suffer a little bit. The longer it takes, the most the business will suffer. And there's a last one that I saw in any single CEO that has been pitching, that is, when you are pitching a business, you oversimplify the business and you put some metrics there and you are just making your storytelling, which is a reflection of the company, of course, but it's the best reflection of the company. When you are just pitching these 1, 2, 3, 4, 5, 15, 20, 30 times, 60 times, this common, there is a big risk that you just put this in your mind as the truth. And the business still have some challenges, still have some things that you are just giving as granted. And you need just to, don't forget that when you just get back to the business will be the same situation that you did. Or maybe a little bit worse, okay? Because you are not putting focus there. So this connection about the storytelling that you are creating in your mind, or the leadership team is creating in their mind when they are pitching and they are selling, I never saw any CEO that I work with lying or saying something that is not true. But it's the most beautiful side and phase of the truth. Yeah. And there's still a less beautiful thing that is still there and that needs to be solved.
Facts. Yeah, indeed. And you are now, as well leading a very successful company, Amenitiz. And so a lot of news in the future, a lot of growth in the future. But tell us, for you personally, what's on hold for you in the coming years? Do you have any projects ahead or any ideas for you?
Yes, so I think that Amenitiz is a great company. It's just as I was mentioning in the past, I think it's one of the biggest examples of high ambition, low ego, willingness to learn. This is something that captivated me from the founders since day one. There's a lot of really interesting things ahead of us in terms of marketing, in terms of solution. Additionally, like in the collaborations that I'm doing with you guys in ICEO, it's like just helping the ecosystem and helping startups to grow is something, it's my passion. A little bit of, I'm trying to give back what I've been learning. I don't know if it's a lot or but at least just to give back, to give it back to people that at least could avoid the mistakes that I made in the past. This is the way that we learn, all of us.
Amazing. And I can confirm that it's worth it a lot. If we look, last question very quickly, if you look at your past, looking back at your career experiences, what would you have done differently?
A lot of things I would have done differently. The issue is that if I didn't do that things in the way that I did it, I would not have learned what I have learned in this. But of course, if I will approach today with what I know today, all the experiences that I had in my previous companies, I will just do things completely different. I will just put focus more in the business, less on the finance itself. I think that at least my experience as a CFO is, it took me a while to focus on what really matters for the business, on what is really adding value, on what are the things that could make a difference in the business. But you need to go through them and you need to learn. And probably I will just get some hires quickly, and I will just get some fires quickly too. Everything will be different. But I think it's part of the learning. I have to say that mostly if I were born again, I will follow probably a similar career. I will be happy with it. Will be helpful just to in my new life. I still have some remembers of my actual life that makes the
To
path
not do the
less.
same mistakes maybe again.
Exactly.
Amazing. And if we look at the accelerating pace of change that is happening in the world, due to technology innovation that is always more and more as well within everybody's life, what do you see are like your main concerns about the digital future, and also what excites you most about this acceleration?
That's a quite kind of philosophical question. What excites me and what concerns me, it's a little bit the same. I think that we are just we have been starting since, I think that when internet happened, in a big revolution for the world. I think that AI is going to be something probably at a similar level. This excites me a lot because I think that there will be a lot of things that we even could figure out today, that in the way that we behave, that we do things like usual things. So if you think about it, a long time ago, most of the things that we do online today is something that we even could think about it, because we didn't understand the reality, the playground that we are going to find. This is what excites me the most. What concerns me the most is what is the price that we will pay as a society for this level of technification in terms of human connection or isolation. I think that there's a lot of the digital generations that already started with cell phones. I think that there's a bunch of things that we didn't know how this is going to impact us in the future. And this is something that I think that we should pay an eye and just keep an eye on it, because there's always, let me say it in a different way. Technology by definition is good, as most of the things that happen. The usage that we do of technology is what it could be good or bad. This is a part that when humans we interact with things, it's when usually then we make it amazing and we screw it to the maximum level too. No? So it's sorry, a bit philosophical, but
Of course. Thanks a lot for your time. It's been an amazing conversation. Of course, we're definitely gonna have many more of this. Meantime, I wish you an amazing day, and gonna speak soon.
thanks a lot, Diego, for having me. It has been a pleasure. I really had a ball, and thanks for the opportunity. Just to share all my experience, if it will be helpful for somebody. My pleasure.
Thank you. Bye bye.
Bye.
Thank you for watching this incredible interview. Leave us your comment with what you think about this episode, what you would like to discuss in the future, or any guest suggestion. And remember that you can follow us on social media. You will find in the description the links. Thank you again for your time, and I see you to the next episode.